You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Mark Helm, an exceptional guest, real estate investor out of Kentucky, focused on scaling self-storage facility. Please help me to welcome our guest. How are you, Mark?
Great. It's good to be here, and I really appreciate the opportunity to share what I may or may not know about self-storage with you.
Your background is really super impressive, and to stick with self-storage for more than 30 years now. But I would like to start with the beginning for you to choose self-storage other than all of the other commercial spaces. What was the upside for you for the self-storage?
Well, just a little story, I guess. My entry point into self-storage was as a real estate broker. I'm a commercial real estate broker, still am, sitting in a real estate company office here. But I was a commercial broker, and I just went through the long process of getting my CCIM designation. And within a week of getting that designation, I got a phone call from the acquisition director of a storage REIT back in, I think it was May 1995. Now, in May 1995, I was primarily in the office business, wore suit and tie every day, had a management company. Basically, I sold office buildings to investors, managed the office buildings, leased the office buildings, did value add plays, and then either continued managing them or reselling them. So when I got this call from the storage acquisition director, it seemed like storage, my relationship to storage it was kind of a pretty stupid little business for small people. And I was actually surprised that there were storage REITs. I'd never really looked into it. But when a person asks a real estate agent if they can help you find real estate, there's usually one answer, and the answer is yes. So I went out with this director and started showing him self-storage in our market. And it didn't take me long to really get what I was showing and what I was looking at. What I saw was that, in essence, self-storage is a concrete slab and a steel wall. You know, I'd also brokered other real estate with concrete slabs and steel walls called warehouse. Warehouse was getting $3.50 to $4 a square foot rent. What I saw was self-storage was getting back then $9 to $12 a square foot in rent. What I saw was that self-storage, these guys didn't have any tenant improvement costs. They didn't have any commissions to pay. When they hit stabilization, their cash flow was pretty steady and pretty predictable. And there were very few pressures below the net operating income line. In the office business, we were fairly good. We would renew about 86 to 88% of our tenants in any given year as they rolled. And when we renew them, we probably spend $5 a foot for commissions, refurbish their space. That's about what it costs to renew a lease. When an office tenant moved out, I mean, it was nothing to spend back then, $20, $25 a foot to put a new tenant in place. Chute would come out the window, dumpster would be set in the alley, walls would be coming down that chute, new walls would go up. And I saw none of that in storage. In essence, I saw a steel wall and a concrete floor generating apartment type rents, but with none of the ongoing capital expenses that really bang into your net income. So I tried to figure out how a guy like me could get in.
Okay, and this is back to 1995. And what was besides this, what was initial step for you to really get in? You mentioned that this was the main upside, but how you started and what was the obstacles on the beginning for you to scale up?
Well, it took me a number of years. When I brokered a number of deals, and I got to see. I didn't do my first self-storage deal for myself till 1999. So for a few years, I was brokering deals, working with this REIT and a couple of others over time, and I got to see how they operated. I got to see a lot of things, how they analyze it. So I finally tried to figure out how I could get in it. Now, I had a couple problems. One is I didn't have any money.
Yeah.
I lived a pretty good lifestyle, but my income would come and go.
Yeah.
So I didn't have a lot of money saved up. And two, I couldn't really sign on a big loan. So those were but I looked at what I did have. And I had the ability to find deals and analyze deals, and I was able to put together a company. I could manage the deals because I'd work with these REITs and saw how they did this. So I just built on my strength. So what I would do is I'd find a deal, I'd get it under contract and situated. I went out and I found operating partners who had a stronger net worth than me, but were still looking to create some wealth. And they saw storage as a way to do it. So we were the ones that signed on the loans and we managed them. And then I would go find investors. I'd get the deal back then, I'd get the deal under contract, then scramble out, find investors, raise 20, 25%. Bring that money in and then close on the deals.
Okay, so you started the whole team from scratch. You and your partner was a operational partner, and then looking for passive investors. My next question will be, what was your approach during the 20s downturns, the market downturns? It did affect the self-storage market or not?
Well, what happened, for what it's worth, not that it's that interesting, but my little history is I put together in the early 2000s a portfolio, and then I was out of the business real quick. We had received some unsolicited offers from some REITs. I didn't want to sell, but the way I was organized was the majority voted, and we were getting offers in 2004, 2005 at values I had projected way out. So I found myself out of the storage business as quick as I got in it. So it took me a while. I did other things, and I finally decided in 2007, of all years, to get back in self-storage. So I put together my first deal, closed on it February 2008. Lucky. Not a good time to be closing on real estate. My conduit loan evaporated. I heard terms I'd never heard before, like your funding is gone. I'd never heard terms like that from lenders.
Yeah.
But this is back when Lehman was going belly up. So we scrambled and closed on a deal. And I got back into business in 2008, of all years to get back in. And here's what I saw. What I saw was, yes, our occupancy went down. Our occupancy went down from, let's say, 88, 89% to maybe 84%.
Not bad.
We spent a little more time on collections than we normally would. But all in all, storage, in fact, that's kind of the problem, not the problem, the challenge today with self-storage. Self-storage performed, great.
During the downturns.
Yeah, during of the big Great Recession. In fact, they're in the commercial real estate world, there were three real estate assets that performed well. One was medical office, which is what? $200-300 a square foot, a lot of capital improvements. Student housing performed well during again, those are like building resorts, and self-storage.
Not multifamily.
Multifamily did okay, but it wasn't stellar. Like, it wasn't getting the returns that those three commercial real estate assets were.
Okay.
So, but what happened was it performed so well comparatively that a lot of it caught the eye of institutional investors. And from the recovery on, now you've got massive amounts of capital out there coming into the self-storage space, driving prices high, cap rates low, and it made it a little more challenging for, not impossible, because I grew during that time period, but it made it a lot more challenging and thinned out our yields a little bit.
So right now, what is your target market around? Like, you're from Kentucky, but do you only focus on Kentucky market or all over the state?
No, we picked up a couple sections of the country, the Southeast and Southwest, based primarily, is our business strategy. Not that it's the business strategy, just happened to be ours. Now, we have sold most of our portfolio. I'm doing a couple deals now, but we've sold most of ours to REITs and funds, simply because the pricing was so high. So right now, what we're doing is we're focused more on conversions. It's even hard for me to do expansions. Our bread and butter was buying a small mom and pop 25,000 square foot facility, then expanding it, let's say, to 50,000, getting it up and running. And at that point, we'd either refinance it and put a non-recourse loan on it, just keep it, or we would at that time sell it. And we would, mostly after we did our value add plays, we would have, institutional buyers lined up to buy them. And so for the most part, we sold them, which wasn't part of our initial strategy, but you adjust to the market. So right now we're finding that the conversions, where you basically take and repurpose an existing building and maybe add to it, expansions, if you can find them, although they're hard to find now because the pricing's so high, and going in smaller second tier, third tier type markets is where we're finding the opportunities, at least for us, that we're looking at. The other thing we're looking heavily at and actively engaged in is doing some large boat and RV storage projects.
Where you focus this?
Our focus here would be in Kentucky, simply because to learn it and do it, and we have a lot of recreation here, and in Florida.
So you mentioned that your strategy was mainly on creating or adding value. I think, what was a creative way to create more income beside adding value when you trying to add more value to your project, especially on self-storage? You mentioned one of this is getting a different value from the actual existing mom and dad self-storage, adding more units, and then selling to REITs. Is any other strategies you did over the years to add more value to your self-storage project?
Well, typically we will expand them, but here's what we notice: mostly, not always, but I would say 90 to 95% of the time, what we purchased is from people who just own one facility, mom and pop people. It's and what we found was that especially people who got into business in the 80s, 70s, early 90s, what happens is they get very complacent with their cash flow. In other words, they don't raise rents very much. Now, there's been a lot of education on the value of raising rents, and we see more people trying to catch up with the market now. But what our experience is, the majority of projects that we bought, the rent rates are 20, 30, sometimes 50% below what the current market is.
Oh.
And what happens is these people they don't want to, quote, lose tenants, where I like losing tenants if I know I can replace them with more expensive, people who will pay more money, pay the market rate. The other thing that we've done is we typically will add other income streams. Very often, Mama, I would say 5-6 years ago, the majority of the people we bought from didn't have U-Haul, for example. And I know U-Haul they would say U-Haul is a pain, and we get upset customers and we have no control over it. And I would just shake my head, and all that's true. But, I have one facility that we made $60,000 to $65,000 a year in U-Haul commissions.
Oh, okay.
That goes straight to the bottom line. The other thing that's been a big boon for us that I was slower than I should have been to adopt, because I was scared, was tenant insurance.
Oh, okay. Yeah. Making
tenant insurance mandatory. I always thought that we would lose a lot of rentals, and it was our, quote, competitive edge. But the reality was, I was just fearful to implement it because it seemed like a lot of money to me. But it's adding, $10,000 to $20,000 a year worth of income to us. Plus, if we ever have a problem, believe me, you want to have tenants that have tenant insurance.
Yeah. But why is you're like getting more income from tenants to pay tenant insurance? Because it's lowering your insurance, correct?
No. In the self-storage business, so let's say that I have a roof leak.
Okay.
My building insurance will not cover.
Yeah.
Nobody's building insurance will cover the contents being stored by the tenants.
Correct.
If a tornado or we have a lot in Florida along the coast, Carolinas, hurricane comes through, blows the building away, blows everything they own away, or everything they're storing in that unit away. Our insurance won't cover that.
100%.
Now, their homeowners, quote, will, but we educate them like you don't want to make a claim on your homeowner's insurance. So, for example, when Katrina hit in New Orleans, within a week, Bader, that was the initial insurance company we used. Within a week, Bader had tables set up, cutting checks to people who had tenant insurance. People who made a claim on their homeowner's insurance, they spent years fighting to get, claims on it. So the tenant insurance is a real win-win. So we ended up making it. How we do it is your goods have to be insured. Now we're going to charge you tenant insurance. Now, if you want to go get a declaration page from your homeowner's insurance showing us your goods are insured in our facility, we'll remove it.
No, that doesn't make sense.
I can count on one hand the number of people that actually do that in a facility. So that's how that's. But what the upside was that we ended up being able to add, on average about $12,000 to $15,000. Huge, big facilities is even more, but $12,000 to $15,000 a year per facility, straight to the bottom line. 100%. Because I got no expense to it.
Yeah. One of the things right now is almost. I think one of the things that you mentioned that the last 5 years was more like a seller market. That's why you sold almost all of, as you mentioned, all of your portfolio to REITs. But right now, we have like a buyer market, and the main issue right now is the uncertainty with the lenders. So, what is your current approach with the lenders and buying deals, especially that we're in the middle of recession? So what is your action right now with the market?
Well, we're not noticing it yet in the storage world here. So interest rates have gone up. The 2-year, I mean, there is a curve on the Treasury notes that quote indicate recession, but there are some other key recession indicators that aren't present, or at least aren't present here. Unemployment is still at a historic low in the U.S. I mean, 3-point-something%. Last month in June, there were over 372,000 new jobs. Now, they might not be the highest paying jobs necessarily, but we have jobs being created. We have low unemployment. Household debt in the U.S. is at a historic low to income. So a lot of the normal recession indicators that aren't there. Now, interest rates have risen. They rose 150 basis points. What Fed says that we're going to be expecting another 0.75. But that doesn't, I mean, interest rates have gone up for small investors, but that doesn't necessarily equate exactly when you go to a local bank. A lot of the banks have a lot of money on their balance sheets to spend. And so even though rates have gone, I don't see an exact tick up in the interest rate quotes yet from a lot of the banks that we use to match exactly what the Fed's doing. And also with a decade of cap rate compression in the storage space, I've seen a little bit of nudging on some properties, but there's still a ton of money chasing self-storage right now. So that's keeping the downward pressure on the cap rate. So I haven't seen a whole lot of movement yet on, I still see a lot of deals being done. I mean, if you're running a fund and you got to get $50 million out the door in the next quarter because you owe money on it, you're going to do deals. So a lot of transactions, yes, it's slowed a little bit, but at least in the world I traffic in, I haven't seen, there's still a lot of deals happening. Now I'm waiting for the cooling off because that will actually help me a little bit, but it's still a pretty hot market.
I think I want to focus on this part because some people doesn't understand the difference on the return on investment between the self-storage and multifamily, because in the multifamily business right now, all of the available yields around IRR around 15 to 16% maximum. So right now on the market, how you can like describe the internal rate of return for a self-storage business and the total within 5 to 6 years equity multiplier, how you can like compare apple to apple here between self-storage and multifamily?
Well, multifamily is hot, but it right now on a 5-year, 5 to 6 year, I would probably be at 15 on the low end, 18 on the high end, internal on the average storage deal I'm doing. And if storage has a downside, I don't know what it is. It's slow. So when you're doing a multifamily deal, I mean, how long does it take you to lease up? It tends to be fairly quick. With storage, it takes on the average facility, it takes 30 to 36 months to hit stabilization on self-storage. It tends to lease up slower. So if we're building or doing adding 25, 50,000 square feet, I've got to build in 2 or 3 years in there to hit stabilization. So I'm getting 22% to 25% internal rate of return on my 10-year on a 10-year cash flow statement, I'm getting, 15, 18 on 6 years.
Oh, okay. This is, I think, one of the main things about stabilization after adding value between multifamily and self-storage. I want to highlight something else that I want to highlight about your book. Can you talk about a little bit about your book?
Well, it's a little old now. I wrote it. It was published in 2015, but
Yeah.
My goal was, well, first of all, I was raising a lot of money back in 2015. So I thought by writing a book, it would help establish me as somewhat as, somebody knows what they're talking about. But it's really it's really helped me a lot, opened a lot of doors. I wrote the book, and basically, how do I put it? Storage can be a boring business. Once you're stabilized, there isn't a lot happening. It's a yawn. But I found out investors like that. So I ended up, I wrote a book, and I tried to explain to the small investor how I got in, what mistakes I've made, and what I would do different. So I tried to I would talk about a concept of, let's say, internal rate of return, or how to analyze a property, or what's the difference in analyzing self-storage to another real estate asset. And then the next chapter would be like a story. I'd done a number of transactions by then, but I took one deal and I would translate that into a story, that's kind of a narrative on how I applied that concept in a transaction. So the book was a combination of my story plus introducing concepts. And, it still sells every month. I'm pleasantly surprised.
There's not a lot of books about self-storage, to be honest. And your book is one of the best book I see on the market, I think.
Well, thank you. Thank you. And I try to, even when I'm work coaching, some of the things I do is I sell training and financial analysis software, but I also do coaching. But I try to share everything I know about it. I don't try to hold back, or I don't view people as potential competition. I've just found that if you, in life in particular, but in business, life in general and business in particular, if you share what you know and are, an open book, so to speak, it always comes back to you multifold. So I tried to share at the time I wrote it, and even today, I try to share everything I know about the business. And I still think it's the best business, and particularly the best real estate play for the small investor. It's the lowest foreclosed on asset class there is. You can predict your cash flow more accurately than with anything else. Once you're stabilized, I've never seen a project go, let's say, from 90% to 50%. I've never seen a project that was stabilized go bankrupt. They're probably out there, but I've never seen it, and I don't know anybody else who's seen one.
Yeah.
It just doesn't happen in storage. Or I've gone from 93% to 85% when somebody opens next door, but I've never seen one go belly up once you're stabilized. The risk is in the lease up. But it's a great business because a guy like me could get in it, and I didn't have to worry about, I'm going to need $300,000, $500,000 this year for capital improvements and commission.
Yeah.
You just don't have that.
What is I think in your model you're doing it as a syndication, correct?
Yes.
Yeah. So it's similar on like multifamily with the same acquisition fee, 2%, 1%, or is the actual structure for fees as a sponsor or as an operator is different than multifamily?
Well, you can set them up any way you want. I didn't take acquisition fees.
Hmm.
Now, if I was running a fund, I probably would, and probably have a yearly, but I'm not in the fund business. I primarily